Bitcoin's next chapter. From ignored outsider to Wall Street's big bet. When Bitcoin first emerged, it was the domain of tech geeks, libertarian idealists, and speculative retail traders. It floated on the fringes of the financial world. Big banks and institutional investors gave it little respect, or worse, dismissed it. But that era is over. A major paradigm shift is underway. And for investors who understand the move, Bitcoin's future could be far brighter than many expect. Number one, from skepticism to structure. In the early years, institutions regarded Bitcoin as a fringe asset. As one review notes, the gatekeepers of global capital were initially very skeptical of Bitcoin. Big banks called it worthless, said it would not survive, or likened it to money laundering. But slowly things changed. Institutional adoption moved from maybe to when. As described, now, however, the tide seems to be turning. Institutional investors, banking giants, and multinational corporations have adopted Bitcoin in big ways. What changed? A few things. Bitcoin matured. More infrastructure, more regulation, more institutional-grade custodians. Scarcity became clearer. Fixed supply, growing demand. The narrative shifted from crazy internet money to digital asset, store of value, hedge. Entry paths opened, ETFs, funds, custody services, large corporations accumulating. For example, one commentary says, Bitcoin market cycles are being disrupted by rising institutional ownership, now at 14%. Thus, the story is no longer just about retail FOMO, it's about serious capital, and that capital plays by different rules. Number two, the Wall Street playbook on Bitcoin. Here's where your core thesis comes in. Now that Wall Street is in the game, they won't just buy at the top and hope for the best. They'll maneuver for advantage. That can include pushing price down or allowing, catalyzing weakness so they can accumulate more cheaply before the next leg up. Why might they do that? Consider. Institutions prefer large-scale entries that don't spike the market. Big buys push price up. Better to enter with some stealth or during weakness. If they believe in a long-term uptrend, buying low matters. They have tools, relationships, and information to position ahead. A shift from retail-driven to institutional-driven means the dynamics of who moves price and when are evolving. In fact, some analysts point to this very shift. Wall Street has taken over Main Street. Sellers beware. And the key, the accumulation phase may be masked by periods of correction, consolidation, or price pressure. That doesn't mean the trend is broken. It means the players are different. Number three, what this means for Bitcoin's price path. Putting the above together, here's how the scenario could play out. Bearish phase. Correction. As institutions start to accumulate, they may allow/trigger further pressuring of price. Retail gets spooked, weak hands exit. Some media narrative turns negative. Accumulation quietly continues. Institutions, or large corporates or funds, keep buying during the weakness, building position. Trigger event, structural shift, perhaps an ETF milestone, regulatory clarity, mass adoption event, large corporate treasury announcement. This changes sentiment. Rapid upside. Once accumulation is largely done and supply is constrained, price shoots higher as demand accelerates. The cheap money has been loaded. Institutional dominance. With major players in, Bitcoin becomes less a speculative crypto fringe and more a mainstream asset class. Thus, the short-term pain, price dips, or sideways action may feel frustrating, but it may simply be the accumulation phase before the next big move. If you believe institutions are now buying, that becomes the fuel for the future rally. Number four, Why Bitcoin's future looks stronger than ever. Here are some reinforcing factors. Scarcity. Bitcoin's supply is capped at 21 million. The more demand from institutions, the greater the supply squeeze. Structural demand. With ETFs, funds, corporate treasuries, pension funds potentially entering, demand is no longer just speculative. Growing integration. Research shows Bitcoin is becoming more correlated with traditional financial markets and more integrated. Maturing infrastructure. Custody, regulation, compliance, institutional access have improved significantly. Shift in narrative. From crazy coin to digital gold, store of value, hedge, or strategic allocation. The mindset is changing. These factors suggest that when the next big leg up happens, it may be stronger and broader than past cycles. Number 5, warning signs and risks. Of course, no asset is without risk. A few things to keep in mind. Short-term volatility. As seen recently, Bitcoin can suffer steep drawdowns, and institutional money isn't immune. Regulatory risk. Governments still grapple with crypto regulation. Unexpected rulings can disrupt sentiment. Liquidity and flows. Institutional flows may bring stability, but also models similar to faster money. Rapid flows out can cause pressure. Sentiment reversals. If the accumulation story stalls, or if institutions lose interest, price may languish. Market structure risk. As institutions dominate, Bitcoin's behavior may change. Less localized pump and dump, more macro-driven. In other words, this isn't a guaranteed moon scenario, but the risk-reward now looks more asymmetric than when Bitcoin was purely a retail speculative gamble. Number 6, how to play this scenario from a trader, investor lens. Consider positioning early. If you believe the accumulation phase is ongoing, being positioned ahead of the next leg gives you leverage. Use corrections as opportunities. If price dips or consolidates, it may be a chance to add. Manage risk. Since institutions are entering, sudden moves both up and down are possible. Use proper stop losses and sizing. Monitor institutional signals. ETF flows, corporate treasury announcements, large holdings disclosures, institutional custody services getting inaugurated. These are clues that the big money is moving. Have a longer-term view. The accumulation by institutions suggests this is more of a multi-year play than a next-week trade. Don't ignore sentiment. Weak retail sentiment may actually be a positive in this scenario. The smart money may prefer low expectations to ramp quietly. Number 7, conclusion. The quiet before the storm. In summary, Bitcoin is entering a new phase. No longer merely the domain of e-commerce tinkerers or speculative moonshot buyers, it's now legitimately on Wall Street's radar. With that comes both opportunity and a different dynamic. The big players don't simply chase price. They plan, they accumulate, and sometimes they wait for the right moment. If we are indeed in a phase where institutions are quietly buying whilst price is suppressed or consolidating, then the next major move upward may be stronger than many expect. The narrative of they'll buy and control Bitcoin isn't hyperbole, it's a structural shift. And if that's the case, then being ready for the aftermath of the accumulation phase is more important than chasing the top of the move. So yes, Bitcoin may go up in the future, perhaps far higher than many currently imagine. The key is recognizing that the game has changed. Wall Street isn't ignoring Bitcoin anymore. They're entering it, and before they accumulate in earnest, the price may be pushed down or allowed to drift lower so they can buy at a cheaper price. For investors who understand this dynamic, the opportunity is significant. In the end, whether you believe Bitcoin is being pushed down on purpose or simply moving through another cycle, one thing is clear. The game has changed. Wall Street is here now, and they don't buy at the top. They prepare, accumulate, and strike when the rest of the market is fearful. The next major move could define the future of digital assets for years to come. So what do you think? Will Bitcoin crash first or explode to new highs? Thanks for watching, and please drop your thoughts in the comments below. And don't forget to like, subscribe to MMS channel, and hit that notification bell so you don't miss our next deep dive here on Money Matters Smart. Because in the world of money, staying smart is what truly matters.